Hey everyone, welcome back to Accountant Connect and LCK Consulting's channel where we break down complex financial topics into easy-to-understand insights. Today we're tackling a big question for business owners in Canada and the USA. Cash versus accrual accounting. Which method is best for your business? Choosing the right accounting method is crucial. It impacts how you track your income and expenses, how much you pay in taxes, and even your ability to secure funding. We're going to break down the differences between cash and accrual accounting, examine the pros and cons of each, and by the end, you'll know exactly which method is the right fit for your business. Let's dive in. First up, cash accounting. This method records income when cash is actually received and expenses when they're paid out. Think of it like managing your personal finances. You get paid, you record it. You pay a bill, you record it. Simple, right? Let's say you're a freelance graphic designer. You complete a logo design for a client and send an invoice for $1,000. Under cash accounting, you wouldn't record that $1,000 in income until the client actually pays you. Similarly, if you buy a new laptop for your business for $2,000, you'd record that expense in the month you actually pay for it. This straightforward approach makes cash accounting incredibly easy to understand and implement, especially for small businesses or those just starting out. It's less complex than accrual accounting, requiring less paperwork and bookkeeping. You can easily track your cash flow and see exactly how much money you have on hand at any given time. This method is particularly beneficial for businesses with straightforward transactions, like retailers or service providers who get paid immediately for their goods or services. Think of a coffee shop. They're dealing primarily with cash transactions, making cash accounting a natural fit. However, while its simplicity is a major advantage, cash accounting might not give you the complete financial picture, especially as your business grows. Imagine that same graphic designer lands a big project, a website redesign for $10,000. They send the invoice in December, but the client doesn't pay until January. Under cash accounting, that $10,000 would only be recorded in January when the payment is received. This can distort your financial reports, making it seem like you had a slow December and a booming January, when in reality, the work was done in December. This can be a problem when you're trying to analyze your business's performance over time or secure a loan. Lenders want to see consistent revenue, and cash accounting might not accurately reflect that, even if you're killing it. So, while cash accounting is great for simplicity, it's essential to consider its limitations as your business expands and transactions become more complex. Next, accrual accounting. Here, income is recorded when it's earned, even if you haven't been paid yet. Expenses are recorded when they're incurred, not when you pay them. This method focuses on matching revenue with the expenses incurred to generate that revenue, giving you a more accurate picture of your business's profitability over time. Let's go back to our graphic designer. Remember that $10,000 website redesign project where the client paid in January? Under accrual accounting, even though the payment wasn't received until January, the $10,000 would be recorded as income in December when the work was completed and the invoice was sent. Similarly, let's say our designer signs up for a year-long software subscription for $1,200 in January. Even though they paid for the entire year up front, under accrual accounting, they'd only record $100 in expenses each month, representing that month's use of the software. This paints a clearer picture of your financial health. You're not just seeing cash coming in and out, but understanding the true profitability of your business operations. This is crucial for making informed decisions about pricing, expenses, and investments. Accrual accounting is often favored by larger businesses or those seeking investors or loans. It provides a more comprehensive view of your financial performance, which is what lenders and investors want to see. Publicly traded companies are even required to use accrual accounting. However, this detailed approach comes with its own set of challenges. Accrual accounting is more complex and requires a deeper understanding of accounting principles. You'll likely need dedicated accounting software or a professional bookkeeper to manage the process effectively. The initial setup can be more time-consuming, and you might need to invest in training or resources to ensure you're implementing it correctly. There's also the potential for confusion if you're not tracking your receivables, money owed to you, and payables, money you owe diligently. For example, if your clients are slow to pay their invoices, your accrual accounting reports might show a healthy profit, even though you don't actually have the cash on hand. This highlights the importance of managing your cash flow effectively, even when using accrual accounting. So, which accounting method reigns supreme? It depends on your specific needs and the nature of your business. Cash accounting is like your reliable, easygoing friend, perfect for simplicity and keeping track of immediate cash flow. On the other hand, accrual accounting is like that super organized friend who plans everything, ideal for long-term financial planning and presenting a more comprehensive view of your business. If you're still unsure which method is right for you, contact accounting. Connect at www.accounting-connect.com or LCK Consulting at www.lckconsulting.org. We can help you evaluate your business needs and ensure you're compliant with Canadian and U.S. tax regulations. Thanks for joining us today. If you found this video helpful, give it a thumbs up and don't forget to subscribe and follow for more business insights. See you next time.